Today I'm going to be talking to Every's investment manager, Tom Leahy, how he's dealing with the volatility in emerging markets. So Tom, the media is full of stories on emerging market turbulence. How are you coping with it?
Coping pretty well, but you're right, Linda, it has been bumpy. 7% declines last year, 7% declines in the first month of this year alone. But we were reasonably prepared for it. We've had a period of where quantitative easing was set to be unwound in the US, and it was fairly logical that the emerging markets would suffer during that period of time when US investors took their money back from Asia and put it back in the safety of the US dollar. So Asian currencies have been weak, and emerging market debt has been particularly badly hit. Thankfully, we had zero exposure to that area, which we're very pleased about. We did, of course, though, have equity exposure, which has been hit. Thankfully underweight, but still nevertheless a negative. But at these sorts of valuation levels, we're starting to see attractions and opportunities, not risks anymore.
So much seems to hinge on China. Robert Peston's report on the BBC seems to have raised alarm bells. How much of a risk is it?
Well, certainly where Robert Peston is involved, you can expect a fair degree of doom and gloom. And you're right, that article has attracted a lot of attention. The things that he focuses on are certainly true. There has been a big debt build-up in China, both within the banking sector and within property sectors. However, what Mr. Peston doesn't do is focus on the cash reserves that currently are sitting within private sector bank accounts, where there are $4 trillion of money waiting to be unleashed when the consumer society arrives, and at least $2 trillion of foreign exchange reserves the Chinese are able to use to invest in their economy. We are expecting there to be reforms in China. We are expecting there to be a liberation of the consumer society and a rebalancing, but this will take time, and it does for the regime there clearly carry some political implications.
Well, that seems okay, but there must be some impact on global growth. How can you quantify it?
It's hard to quantify it exactly, but certainly we've seen results from luxury good exporters out to China suffer in the last 6 to 9 months, so there is a slowdown happening there. We've seen a lot of focus on the likes of Brazil, Turkey and India, where growth forecasts have been taken down, but overall they're not enough to collectively derail the recovery in global growth. Far more important for the overall figure really is what's happening in the US, where forecasts have been increased, and this year expecting GDP growth of around 3%. That's more important for global growth. And not forgetting that old emerging market, which perhaps now is a re-emerging market, and that's Japan. They themselves are going through a major quantitative easing experiment, and so far the responses have been positive in terms of growth. And one last point about quantitative easing, which is important: the slower the Asian growth is, the more impact it has on world growth, the slower will be the unwinding of quantitative easing in the US, in Japan, the longer the interest rates will stay lower, and the more supportive that is for equity investments all around the world.
So after all that, you still see Asian countries at least growing faster than the West?
I do indeed, and you don't just have to take my word for that. You can look to the IMF, who are talking about growth of 6.5% for Asia in aggregate. That compares with 2.5% for developing markets, so a big difference. Asian governments are generally well financed. There are some well-known exceptions, and Asian corporates are in a good place in terms of their balance sheets, profitability and cash flows. And in addition to that, a very strong dividend culture has started to emerge in Asia, and now we can find a large minority of the world's highest yielding stocks to be found in those markets. That gives us a good opportunity to aim at.
Thank you, Tom. That's all very clear. We look forward to catching up with you again soon.
Thank you, Linda.